Howard, why don't you kind of kick things off, introduce yourself, kind of your background. I know you're a storyteller, so let's hear the story of how you got into crypto and the whole experience there.
Sure, thanks. And again, I want to thank the Dexible team for thinking of me, inviting me, and for everyone listening, either live or on the recording. It's gonna be a fun night. Everybody Wang Chung tonight.
God.
All right, so 10 years of banking, 10 years of public accounting, culminating in me being a partner at a top 8 accounting firm in the U.S. in charge of regulatory compliant valuation of hard to value assets. So I can't appraise a chair. I can't tell you how much your car is worth, but my job would be like, what are the Olympics worth? What's NBC worth? The Coca-Cola brand. Clients were like, when Capital One Bank bought ING Bank, I was hired by Capital One to figure out, what do you pay for a bank? When United Airlines went bankrupt and they had a $30 billion pension comprised of about 20,000 investments, everything from McDonald's stock to sovereign tax certificates. Like if you overpay your taxes in Egypt, you have to apply to the government to get a rebate, and then they decide whether to pay you back the overage. And so there's a whole securitization market around that. And so that's me. I was a quant jock, but partner, managed a big team, global outreach, all that fun stuff. And my partner, Ryan Medlin, I knew him from when I lived in Charlotte. We used to go to shows together. He was a neighbor of mine. He was an Internet of Things. He'd had an exit to New Star. His startup had gotten an exit. He was still in Silicon Valley. He's the godfather to my daughter, best man at my weddings. He came to visit and over a plate of cheese fries with gravy, which called disco fries in North New Jersey. He was like, we got to get into crypto. And I said, it's a bunch of malarkey. I don't believe it. He told me there's a market for it. So we started ideating. Like, I said, okay, fine. So we won't be in crypto because I didn't buy it. But I was like, maybe you can make loans against Bitcoin. And so we were about 90 days behind BlockFi, but doing essentially the same thing. And that's how I got, like, I didn't get into crypto because I believed in crypto. I got into crypto because I believed this was a liquid, marketable asset. And as long as you could define control, somebody can make a loan against it. And I was sold.
Clearly, you and Ryan have a long history together, and that's awesome. How has the team grown since you guys started the company together?
Yeah, so it was we bootstrapped, right? Like we weren't making any money at first, and we don't have any silver spoons on our team. We're blessed to know some very well-off individuals, but everybody is so skittish. Even now, like, again, we're still in the early innings here, and that might be like, it might be like being a dead horse saying that, but it's still in the early innings. And so we had a real hard time getting people that had deep pockets to really buy into what we were trying to do. So I was working, like I said, full time as a partner in this accounting firm. Ryan was working full time at a different startup. And the first thing we did was we created a company called Your Performance. And we created a Wix page. I learned how to like write JSON calls to like come up with new loan to values for Bitcoin, Litecoin, Ethereum, and I think that was it. And we used one of those like free database tools. I can't think of the name of it offhand, but it's like a pretty well-known one. And so we created our own loan origination system, wrapped it in Wix. We got FCRA, Fair Credit Reporting Act approval to pull credit scores. And we just kind of put it out there in the ether. But we found out very quickly, you can't do centralized crypto lending. Like, it is impossible, even today, to run a business where you accept collateral, like accept Bitcoin, and then give someone money for that Bitcoin. And you're asking yourselves, like, well, why is Howard saying that? There's BlockFi, there's Nexo, there was Celsius. What we discovered, and we got this whole consortium together in SoCal, made up of like some of the top consumer lending minds in the industry, and we dry erased it. And we were like, look, to be a borrower, can I describe why centralized lending doesn't work right now?
Go for it. Yeah, go for it.
Okay, good. So it's super simple. It's still a problem. It won't work for years. So if you have your money with a centralized lender, you should get while the getting's good. My 2 cents. Do your own research. The reason is this. The demographic of the average US borrower that would borrow against their crypto is an 18 to 45-year-old male with an average of $50,000 to $60,000 of debt, most of which is college student loan debt, $10,000 less today for some of them, that is already at a low rate. So like the use case for borrowing money is either because you need a large one-time expense to cover, or you're consolidating. So you're not going to consolidate here. So the people that fit that box. Oh, and then on top of that, typically you can only borrow up to 50, 60, 75% loan to value, meaning I put up $100 of Bitcoin to borrow $75 of cash. So the few people that have the 20,000 plus of Bitcoin to really qualify for this type of product, it would cost you an arm and a leg to market to those folks. And the marketing cost, the acquisition cost, has to be recovered in the interest rate you charge. And we figured out that just the acquisition cost on a $20,000 to $40,000 loan, meaning that the borrower would have to hold 35 to 50,000 in Bitcoin, is probably like 9 to 10% right off the top. You have about a 5% origination cost, just overhead for servicing. And then most lenders don't use money out of their own pocket because it's too expensive. They go and borrow it. Well, for me to borrow the money to make the loan, they don't care that it's over collateralized. They think it's over collateralized with vapor paper, with Bitcoin. So they're going to charge me like 10%. So when you take the cost of capital for a centralized lender to get cash, the cost to acquire, the cost to originate, you're talking mid to high teens for an over collateralized loan. If you have that much Bitcoin, you could walk into a Wells Fargo or a Chase and get an unsecured loan for 7 and 9%. So the economics don't jive unless you gamble with the borrower's collateral. And that's exactly what BlockFi does. It's exactly what Celsius was doing. It's what Nexo does, all these centralized folks. So the minute we heard that, and this goes back to our origin story, the minute we sat down with these guys and they're like, you don't have a business unless you're going to gamble with people's security interest, and you do not want to do that or you go to jail when things go sideways. He's like, it doesn't work. And so we actually put pencils down for a year to figure out what we would do next.
That actually makes a lot of sense and kind of makes me worried on some aspects, but I'm not going to go down that route quite yet.
No worries.
Why don't we take that transition then and explain a bit more from your perspective why that isn't true for decentralized lending, or how do you address it?
Yeah, well, and this is the evolution of the company. So at this point, we're like a year and a half in. We haven't launched a token, nothing like that. We explored the ICO route, but how we test scared the pants off of us. So we were like, let's keep bootstrapping till we figure this out. When the first paper on DeFi, we use a compound fork today for our live product, the app.unfederalreserve.com product. When the first paper came out on DeFi, we marked it up. And what we found was elegant about self-custodial lending was that you take, like once I set up the rails to let people save and let them save and use their their deposits as the liquidity for borrowers to borrow. If you limit the ability of borrowers to borrow to only those that are oversupplied, you're always going to have, in theory, more liquidity than you'll have loans. So right there, I'm like, oh, this is great. Like, I don't have to worry. I don't have a cost of capital. Like, a centralized lender has to get their money from somewhere. Our pool to peer, our compound fork, doesn't need to get liquidity from third parties because the liquidity is provided by the savers, some of which are also borrowers. So right there, no cost of capital from a company perspective. The other thing is servicing. Well, the way the compound logic works is that when you borrow money and you're charged interest, you don't have to show up and make payments every month. I don't have to go after you. You don't have to wire or ACH. It draws down on your supply every time an ETH block is minted. And I'm like, this is gorgeous. I don't have any servicing costs. And then you bring in bots that when a borrower's loan to value is violated, the bot gets rewarded to take out that technical defaulted loan. Awesome. I don't need a central staff to chase after bad borrowers because the bots are getting paid to do it for me. So now the only cost of running my business is reaching out to folks to say, hey, do you want to make APY on your deposits and borrow at reasonable rates? Just connect your wallet and go to town. And that was the last part. When you go to a Nexo or you go to a BlockFi or Celsius, you're sending your crypto to them. So they have to have the capacity to accept it. They have to store it. And if they're following the law, which in Nexo's case, they're not, they have to have licenses to actually perform that function in the US. So in a self-custodial context, meaning if you're just connecting your wallet and you're never giving up control of your asset, I, as the provider of the platform, I don't have to worry about custody laws. So I don't have any overhead. I don't have any cost of funds. All there is acquisition costs. And that's why pool to peer is super efficient, safe, and honestly the only solution for the next decade.
And I think we saw that with the Celsius shenanigans and who got paid off, and it was always the decentralized borrowing that got paid off, not centralized.
Because the decentralized folks don't give up control of their stuff. So basically, if every person in a decentralized ecosystem like unfederalreserve.com, the retail reserve lending product we have, everybody's over collateralized. So there's excess supply. It's not 100% risk free. And I'll tell you the risk. The risk you run in pool to peer. So this is Compound, this is Aave, this is Maker, this is us. The risk you run is if the collateral that's allowed is very volatile. There are instances where someone could use their moonshot as a supply, borrow stables against it, and then when the moonshot crashes, it crashes too quickly for the bots to pick up. And so in essence, you end up with a bunch of unsecured paper. And here's the Easter egg for and the alpha for the folks at home. If you're, in your basement, eating your nachos, using your belly button to hold your dipping cheese or whatever you're doing, and you just want to do some data play, go to Aave because it's all on chain, and look at how many loans they have where that collateral is lower than the face value of the loan, and that's a write-off. That's just a total dead asset, but nobody has the wherewithal to really write it down. And so I bet there's probably we're going to find out in the next 12 months to 18 months that there's probably a few billion in unsecured loans on all these DeFi platforms because moonshots were allowed as a collateral that are now dead.
That came from highly volatile assets being put up as collateral or being borrowed?
highly volatile assets being put up as collateral. So you could put your moonshot down as a supply, and even on Aave, you could borrow 35 cents on the dollar, or compound, you could borrow 35 cents on the dollar of that highly volatile asset. Well, okay, I put up $1 of my moonshot, I borrow 35 cents of USDC, the moonshot crashes to a penny. So now the collateral is worth a penny against a loan of 35 cents. And that borrower's not going to come back, especially when it's permissionless. That borrower's not going to pay off that loan. They're going to just say, fine. In fact, it's a way to sell your tokens without actually selling your tokens. You put up your crypto and you borrow stables and you take the haircut for the LTV and just walk away. And that way you don't have cap gains. You just took out a loan, and no one's going to come after you. There's nobody to give you a forgiveness letter. There's nobody to claim that you made some kind of income, and now you have a proxy sale.
I guess you would just get liquidated in that scenario, but if it goes down to a penny,
what do you care? Well, this is a great example, right? Let's not use moonshot and USDC. Let's say you want to sell your Bitcoin, right? So you bought Bitcoin I'm going to use fake numbers. You bought Bitcoin at $1, and now Bitcoin's 20,000. When you sell that Bitcoin, you got to pay cap gains on the 20K, right? Cap gains, and depending on your income bracket, you might get hit like by a 30% plus tax rate on that sale. Maybe it's like it's recognized as regular income and not long-term cap gains. So you sell your Bitcoin, you're getting hit with 30+% taxes. Well, instead of doing that, if you find a pool-to-peer lending platform that lets you borrow 80 cents on the dollar, put up your 20K Bitcoin, borrow right to the hilt, you get liquidated, but you're walking away with 80% of your 20K, and it's not a sale. You're just it's a loan you took out, and until the exchange sends you like a forgiveness letter for your bad loan, come on, like no one's doing that. So you just sold. Yeah, you took a 20% haircut, but I'd rather take the 20% haircut by taking a loan and walking than having to pay 30% plus taxes on the sale.
Yeah, and if you did that OTC, you'd take the 20% haircut, just doing a block trade, and then cap gains.
Done. Well, you don't even pay that. That's what I'm saying is like, you would not have cap gains if you're borrowing against an asset that you walk away from. You've just taken a loan that you never intend to pay back. That's not a sale.
I want to ask you about how haircutting mechanics work in some of these protocols. So basically, how does something like Aave, Venus, Compound even, how do they measure the volatility of a token? Like, does it impact their rates at all for lenders? How does it affect what you do?
Surprisingly, this is the beauty of it. If there are folks listening that are like just leaving that kind of quant engineering finance program, and they really want to get into the sauce, the juicy part of blockchain and crypto lending and DeFi, you talk about crypto being in the early innings. Crypto lending, they're still in warm-ups. They still got the mascots running laps around the bases and people throwing opening pitches into the stands. The products are so simplified, it's almost criminal. And what I mean by that is there's not a lot of terms and conditions that have been baked into these protocols to develop very mature interest rate setting, very mature call and put mechanics, very mature call it credit enhancement provisions and what have you. It's all super simple. So for us at app.unfederalreserve.com, cheap plug, Aave Maker, those guys. The only way they can control for the risk of the collateral, the way they draw the box, is by limiting how much you can borrow against that collateral. So in essence, if you have a very volatile token, you start by saying, look, I'm only going to let you borrow 10 cents on the dollar. And you just hope, as a supplier of that token, or rather, as a participant in that ecosystem, you really need to look at the collateral factors of all the supplied assets. And you want to make sure that the more volatile stuff on the platform, folks can't come in and borrow to the hilt against, because they'll just do that. They'll just borrow to the max and sit on the sidelines, and if they get liquidated, great. They're sitting in cash. But they can't do it in rate. Does that make sense? Like, there's no mechanism for changing the rate so that it's higher. And the reason why that is the way the interest rate models work on pool-to-peer protocols is the supply APY and the borrow APY are inextricably linked. So if you were to say, look, this is a really risky asset and we don't really want people borrowing it, I'm going to set the interest rate really high. Well, if you set that interest rate really high on the borrow side, you're not going to get a lot of borrowing. So your suppliers aren't going to get much for storing their moonshot. And that's really it. And there's also, raising the interest rate won't really compensate the suppliers on the platform of, say, the thing that's being borrowed. Hold on a sec, my phone's. Hey, are you guys still hearing me?
Yes. Yeah.
Like, my phone's ringing? How do I stop that from happening? Okay.
You're all good now.
Just smash
Twitter
it.
doesn't have all that functionality built out yet. They're still in the warm-ups.
They're still in the world. So what happens is you can't, if you setting the interest rates high for the, well, how do I explain it? Think about this. You supply your moonshot, but then you borrow USDC. So the interest rate model is actually balancing the supply APY and the borrow APY for the USDC, not the moonshot. Like, these platforms are almost agnostic to the type of token you are supplying when coming up with the borrow rate. So there's no way to sort of cross figure, well, if the supply is moonshot, I should charge them the standard USDC rate plus a premium because it's a riskier token. But if they're supplying Bitcoin and borrowing USDC, I don't have to charge them that premium. The technology is not that intelligent. So you really can only govern the risky tokens by limiting how much you can borrow against it, not in the interest rate.
Yeah, that's jaw-dropping.
It's huge.
Probably
no, totally
why
huge.
we have. Yeah,
but it makes perfect sense. I mean, we don't even have complex future contracts yet, even within the space. So, as you said, it's still in warm-ups.
Right. That's right. And that's why I'm saying, if you're like a quant jock, I remember I was talking to the CEO of Maple, right? Maple Finance, who they do some cool stuff with liquidity pools. Like the way the big sophisticated lenders are dealing with the issue is they use crypto to gather liquidity by paying interest to those liquidity pools, and then sprinkling on their tokens to add that, I call it pseudo value or emotional value. So they seed the liquidity pool, but the loans they make are very traditional, vanilla. Hey, your collateral's risky. I'm charging you a higher rate. I'm capping how much you can borrow. I might even ask you to dox yourself and force you to personally underwrite. That does not happen in DeFi today. And so the only governor is going to be how much you let someone borrow against in order to keep the platform safe. And that was a lesson we learned. We learned it the hard way. When we launched on day one, we had 500 million of supply on the first day we launched. And we were, smoking cigars and popping champagne. And then the whole thing crashed, went from 500 million to $1 million. I mean, I got death threats. You can imagine, right? The whole thing we were destroyed. And it was because we let people borrow 80 cents on the dollar to our own token and then go right into borrowing stables and then disappearing. In essence, a whole bunch of people milked 400 million bucks or so out of our platform. Now, full disclosure, a sophisticated DeFi user would recognize the risk and not touch us. So you totally had a whole mess of people being taken advantage of, but it was soul destroying, and it wrecked us emotionally and personally. But we learned, we're like, crap, like we have to put governors in place to prevent these economic risks from happening, because the code doesn't do it. And there's enough unsophisticated people in the water with these sharks that if we don't put the governors and controls in place, every newbie that walks in is going to be chum for the great whites.
So, Howard, where do you feel that the lending industry in this space is going 12 months, 24 months in the future? If you can snap your fingers and you're out there, what do you think the space looks like? Are those governors built in, or are we still in the same circles?
I think more sophisticated smart contract logic. It can't be in the UI. It has to be in the contract, because there are so many attack vectors once you get out of the smart contract. Here's the other thing, and you guys are going to love this because you come from TradFi. Once you have these smart contracts set up in DeFi, if you make a change, you affect all the on-the-run loans. There's no such thing as a smart contract change in DeFi that grandfathers in the extant obligations that are out there. It doesn't happen. So what that means is like when we were trying to, and we learned this too, man, just incredible learning. We were like, hey, let's solve this problem by lowering the collateral factor on our risky token. So like we, as the company, we're going to change the smart contract, which would force the liquidation of a ton of these loans. And we sat there and we talked to our lawyers, and they were like, you can't do that. And I was like, well, why can't we do that? They said, well, look, imagine you go into Bank of America and you borrow $10,000 against your motorcycle. Okay. And I was like, that's cool. What kind of bike? And they said a Softail. And I'm like, that's cool. I'm more of a Yamaha guy, but whatever. They said, if you borrow $10,000 against your motorcycle, imagine the software company that Bank of America has hired to manage the servicing of that loan. Looked at that loan, looked at Bank of America, looked at you, looked at your bike, and were like, that's a stupid loan. And the software company unilaterally decided to change the terms of the loan that was agreed upon by the borrower and the seller. If a third-party service provider were to mess with the core banking servicing technology, forget it. Game over. So this is the other challenge. So not only are the smart contracts that govern DeFi today unsophisticated, in essence, you can't make changes on the fly because you are interfering with third-party transactions between parties with contrarian interests. So when you say like where's the future going, it's actually going, I think, more towards centralized logic, meaning you enter into a transaction through some DeFi environment. Logic has to exist that preserves what you agreed to as a lender or a borrower and only affects the next loan originated. But that sounds a hell of a lot like centralized lending, doesn't it?
It does. I don't know enough about the space in order to say whether it's possible or not, but I would imagine that it would be able to be set up where that the smart contracts wouldn't be able to be changed. And in order to change them, you'd have to.
Or if you set up a proxy contract, design. I was even reading a paper today that was saying there was a lot of inefficiency because some of these things aren't upgradable. You'd have to have some sort of way to terminate or pause existing outstanding loans, so that way you don't have that weird hiccup. But
that's the problem.
Again,
take fractals. Think Mandelbrot sets. Think fractals. The minute so the smart contracts are, just to be perfectly clear, the keys to our smart contracts that govern our pool to peer are multi-sig and locked, but they can be changed. If I need to change an interest rate model, if I need to change a collateral factor, there's a governance process for that, transparency and the whole nine. Our institutional product, we actually engaged Aegis Trust Company, a South Dakota qualified custodian, to have one of the SIGs mandatory in our multi-sig. So for our institutional product, changes can't be made, wallets can't be whitelisted unless our custodian signs off as well as an added level of protection. That doesn't fix this issue. It just means that, random changes can't happen to the smart contract, only like controlled changes. But you still have the problem of the legacy extant transactions are all affected. And this is why I said think about fractals and Mandelbrot sets. If just this logical argument, if I can change a smart contract to lock in existing terms and conditions and just have the next loan be impacted by this change, then you could in essence crack the smart contract into infinitely small pieces. And a smart contract broken into infinitely small pieces where every borrower and lender combination have their own unique terms and conditions is extremely inefficient and is no different than how banking is done today. You lose the DeFi. Through that. It's pretty nuts. But this is an opportunity, right? It's the opportunity to then say, hey, you know what? Is there a way to maybe have some terms and conditions be unique to the wallets that are in place and only have the new terms and conditions apply to new wallets that show up? But that may never happen, and maybe 5-10 years away. So where it's going to go real quick is I think it's going to be an amalgam, right? I think what you're going to see, hopefully if we've called it right, what you're going to see is permissioned safe harbors, like permissioned ecosystems where there's 100 suppliers and borrowers that are all customers of a bank. They've been vetted. They're all playing amongst each other. And it's almost very hands off. It's almost very set it and forget it, cash for credit, kind of spot market, using DeFi. Or you have the centrifuges where they tie, they take real world assets and securitizations, they tokenize the equity tranches, and you can go and buy like a token that's participating in some like vast ABS. Like I think all that stuff is on the table, but we're just a long way off.
What does the customer look like in the next year? Today you said one of the highest demanded customer demographic is that 18 to 45-year-old male population with that's rattled with debt. What does it look like in a year? Are we still with that sort of consumer base? Does this stuff expand, especially with permissioned products? Does that make it more mass retail focused? What is your opinion?
It depends, it depends on the product, right? So it's not easy to use our product. You can't walk into Walmart, or like whatever and buy a can of Coca-Cola. That's easy. You can't do that in DeFi. Like for our product, and we use big buttons and arrows and plus signs, like we've tried to make it as simple and friendly as possible with tutorials. And you still have to know what MetaMask is, right? Like you still have to know what gas means. You have to click connect and not like crap yourself that you hit connect and all your life savings are gonna get siphoned out, right? Like there's these trust hurdles and there are these steps that have to be taken that are huge barriers to mass adoption, even in the most sophisticated platforms. The first products that really take on mass adoption have to be like simple Robinhood buying a stock product, right? From a DeFi perspective, you can have this pool-to-peer infrastructure that again eliminates the servicing costs and it eliminates the cost of capital, but the activity, the actions, that the use case, the use flow has to be nothing more than, oh, here's my name and my email. Great. I verified. Okay, great. 2FA, maybe. Again, I don't know how you get over the wallet issue, right? Because it's self-custody. So the user a year or 2 years from now still has to have the wherewithal to know what a wallet is. But beyond that wallet connect function, it can't be scary. And it has to feel like they're making a deposit at their local bank, or if they're taking a loan, like they're drawing off a credit card. I think if the usability can evolve from, it's 2 a.m. and you're staring at your monitor and you're like, do I press the plus sign or do I hover over it? Like, if we can get away from that mindset and more towards, this is easy. I'm opening an account. I'm putting in money. I'm earning 5%. Oh, my money is going to be used to make loans. That's great. This is how much money is available in the pool. So I know that I'm not going to get locked. Awesome. And to need money, it's press a button. This is where I want you to send it. If we can get there with the usability, I think you see greater adoption, but you're not going to pick up Gen X. You're not going to, the baby boomers, forget about it. They're done. And the next trillion is probably going to be the folks that are in their early 20s today with some extra scratch, but willing to play in the space. And the institutions that have sophisticated treasurers that are like, yeah, I'm okay. Like, I know what a wallet is, and I know that I'm working on behalf of this hedge fund, and I'm putting 20 million in Bitcoin into Aave Arc, and I'm not going to get fired or go to jail. So I think that's the next year. The institutions that are forward-thinking crypto users that have folks in-house that are comfortable, and you're like young 20-somethings kind of meeting the greater usability as it improves.
So basically, wallets need to get to the point of trust where we are today with Square.
Yeah, would you agree with that?
Yeah, I think that's one of the biggest hurdles today is basically crypto's scary for people that don't know what to do. Even in the gaming scene, that's as low risk as you can get playing a video game. But there's a lot of steps you got to go through that you have to know ahead of time in order to even play ball.
I literally had a conversation this morning. It's this guy bought 1 million of Bitcoin in 2010. So he's worth about 130 million now. But he's still bearish, or sorry, he's bullish, right? So he doesn't want to sell. But he needs to borrow like 40 million bucks to do this commercial real estate deal. And, I'm getting calls because of my network and stuff to say like, hey, can you help this guy out? And the banker I'm working with is like, why is it taking so long? Like why can't he just give you his USB, his USB thing, his fob with the Bitcoin? And he's like, are you going to put it in a safe? And I'm like, oh my God, you have no idea. And I'm like, you should stop talking. But I'm like, he means well. But I was like, no, I'm like, listen, not only does the lender need to verify like the liveliness and the veracity and the source of, not only does the lender need to do everything that lenders do today to make loans, which is, are you real? Do you have the ability and willingness to pay? And is the collateral you're putting up safe, or is it like giant bags of cocaine, right? Like as a lender, they have to do all their natural stuff they do today. But what's unnatural is the borrower, because they are giving up custody of their collateral, they have to look at the lender and say, who are you? Who are you, lender? Because I'm about to give you 80 million in Bitcoin to borrow 40 million in cash. I want to know, the borrower has to do as much of an underwrite on not only who the lender of record is, but also where's the collateral going to be held? What wallet is my token going to be sitting in, and who has control over that wallet? And prove to me that the guy at Fidelity, where I got a nice letter from Fidelity saying, send your collateral here and we can process your transaction. How do I know that's really Fidelity letterhead? How do I know that the guy that built Fidelity's infrastructure for their custody didn't leave the firm 2 months ago, or is going to use my collateral to go to Mauritius? So the level of trust and sophistication that has to be built between every party is like 5x, 10x what happens in traditional finance today. And that, it doesn't mean it's impossible, but it means it's expensive. And if it's expensive, that means that there's a better, a better alternative. And that's going to be what keeps the industry from evolving, is just the lack of trust and the need for all the elements in the ecosystem to constantly verify and re-verify. And that's antithetical to crypto. Isn't crypto supposed to be trustless?
Yeah, you raise a pretty good point there.
Yeah.
I did want to ask about what's coming up on the federal roadmap. And there's been a ton of talk lately about on-chain credit score. Even today, I saw there was a new product that got, I think it raised a 23 million Series A for on-chain credit. Is this something that you guys will take into consideration? Is it going to add like a layer of friction, or is it going to make lending and borrowing more efficient and reduce overall volatility and even some of these trust issues?
So for over-collateralized lending, like for the compound forks of the world, the credit scoring, you don't really care. Like, I hate to say it, but the reality is if in a self-custody pool-to-peer compound fork, as long as what people can supply and borrow are relatively stable, then you care less about the ability and willingness to pay, and more about the fraud, right? So on-chain credit performance isn't really going to help you with fraud. Really that has to come from some sort of like KYC process. So we don't have any plans to implement any kind of credit scoring on our pool-to-peer product because it is over-collateralized. It would be a cost, and you wouldn't. No decision would be impacted by someone with like a lousy credit score versus a good credit score, because like I said before, right? I can't adjust your interest rate. like I can have interest rates be adjusted, but really only for some very global factors, not specific to you, Bob, or you, Sally. So where on-chain credit does come into play is I'm sure centralized lenders love it because they need a way to score their borrowers, and not, and you can't go to CoreLogic or Experian or any of the kind of the existing agencies to figure that out. Credit scoring also comes into play for unsecured or low secured borrowing, and that's not what the pool-to-peer technology is. So for the most part, credit scores will help centralized lenders make decisions, but decentralized lenders in a pool-to-peer context, not so much. One exception is this goes to the unfed roadmap. So we have our institutional over-collateralized pool-to-peer product in test. It's liveried to our bank. It's called Reserve Lending Plus. You can sign up for a demo. It's super slick. I love it. It only allows for supplying of Bitcoin, Ethereum, and USDC. So that's the entirety of the pools that are allowed. The next generation for Reserve Lending Plus is called Reserve B2B, which is a cash for credit spot market. It exists today in the traditional space where a company like a mortgage originator has these massive $50, $100 million cash deficits and surpluses, that if those deficits and surpluses hit at the wrong time of the month, these entities have to go out into the market and borrow cash like overnight. This is kind of like the repo market in a way. In that case, where you're going to allow institutions to borrow unsecured against kind of a universal liquidity provider, in our case, Galaxy Digital would be the lender to this collateralized B2B lender. There, you have to underwrite the company for credit, and you got to set, a borrow limit for them. And you also need cross default provisions from them so that if they do default in this DeFi space, just because it's DeFi doesn't get you off the hook. You still got to pay what you owe, says Rihanna. Pay me what you owe me. So yeah, because I love Rihanna. But that's so on-chain credit scoring. I think it's cool. I think it really plays to soul-bound tokens. Like, I love soul-bound tokens. I love the idea of taking personal elements about who you are, what you are, and how you perform, and having them like immutably recorded so that lenders can make decisions based on that data. But that's not a DeFi concept. That's a CeFi concept.
Yeah. Well, Howard, we're getting close to the end of the top of the hour, as radio hosts would say. Obviously, Dexible and Unfederal Reserve we're putting out our partnership here soon.
Woohoo!
Yeah. How do you feel like that's going to change the business in terms of making things a bit more easy for your current customers and actually getting borrows in the right asset?
Yeah. Well, I mean, I love the Dexible product suite. I love it. Like, I'm like literally, if I wasn't married, and I'm even thinking about leaving just to marry you guys. So, but you can't marry a company in the US. So even though they are a person, which is weird, right? They're a person, but you can't marry them. That's not cool. And I'm sure you'd visit me in the hospital if we were, but
we're not great on dates.
We're not great on dates. Do you go Dutch? Are you cheap?
I just, walk away sometimes.
Sometimes, I gotta go wash my hands, and you ghost me. No, so this is where I think it really helps. So we talked about the fact that we have this over collateralized pool to peer system, and we only talked about one use, and the use we talked about was actually a very bad use. We talked about using a pool to peer lender to effectively have a proxy sale and not incur capital gains. And we didn't even talk about how you get these receipt tokens. So if on December 31st you have like a big loss, you could like call it a sale, and then on the next day you withdraw your supply, and you get that loss. We didn't even talk about that like little bad thing. But let's talk about some of the good use cases. The good use case for pool to peer is this: if you're long a crypto asset and you don't want to sell, you can obviously borrow against that asset using pool to peer, and you could borrow stables and then go off and trade and do whatever you want. So it's a great margin lending tool that works best with trading tools. So my hope is with Dexible that through our integration, users of the Dexible tools, the Dex tools, would connect their wallet, deposit and earn interest on the assets that they're not trading, and then borrow and put the borrowed assets through the Dexible tools to do their trading. So in essence, you get instant margin and trading capability by us joining forces. So that's
Couldn't
huge.
agree more. Yeah.
The other use, and this is true honestly for any like permissionless or even permission but wallet-based connecting platform, our pool-to-peer software will boost volume, we think an estimated 30% just by giving that margin capability. And we're gonna, you and me, Dexible and Unfederal Reserve are gonna demonstrate that for sure. The next use case is for shorting, right? One of the things that happens is that your borrows on the compound fork, your borrows in pool to peer are denominated in the currency you borrow. They're not denominated in USD at the time you take out the loan. So if you supply Bitcoin and you borrow Link, you supply Bitcoin, you borrow Link, and the price of Link drops, well, your loan just got cheaper. Well, one of the things people can do is they can supply whatever they want to supply, they borrow what they want to short, and instantly convert to stable coins, let's say. And they can do that using the Dexible tools. So now they've supplied an asset, they've borrowed the thing they want to short, and they swap using your tools. Well, when the price of the thing they were shorting drops, they use your tools to swap back into that asset at now a lower price, and they pay off their loan, and they've now made the value of that drop in essence by using our combined tools to short those assets. So you can use it to short, you can use it to margin, and right there is enough of a reason to go off into the sunset together.
Better than the sum of its parts, for sure.
Yeah.
I do want to have some time so we can see if
anyone
wants to put out any questions, and then if not, Howard, it's been a great conversation. So let's just wrap it up there. Howard, I appreciate the time. It was great talking to you, and we'll continue on things.
Yeah, I appreciate it, and I like I said, I think we're gonna do great things together, and just let me know if this recording's available. We'll put it out into the ether, and let's spread some knowledge.
Absolutely, couldn't agree more.
Right. I really appreciate it. All right, I know it's bear market conditions, everyone, but stay the course. Diamond hands, everybody.
Exactly. All right, Howard. Have a good one.
You too. Cheers.
Later, guys.